So, Jenny, kick it off.
Okay, good morning, everyone. Thank you for joining us for the ActivePort Investor update. My name is Alan Chan for Bridge Street Capital. I have my colleagues Alex Sundich and Roddy Clarkson in the room with me. And we have Peter Christie, ActivePort Chairman, to present. Just note this is being recorded, and if you have any questions, we can address them towards the end during the Q&A session. So Peter, over to you. Thank you.
Thanks, Alan. So Q1 FY24 update. Obviously, most people know myself as Peter Christie, Chairman and CEO of ActivePort. Quickly skip through the disclaimer. And for those that haven't come across ActivePort before or are new to the story, quick summary: ActivePort is an Australian software company that delivers edge-to-cloud network orchestration solutions to the global telecommunications industry. Important point here is we're a software company. ActivePort does not build networks. We don't own networks. We write software. We deliver that software. We license it to our enterprise customers and our telco community. That is how we derive our revenue. And so, like all good software companies, we're chasing a high margin software revenue, low capex, low opex. We hope to build a very, very successful business with good free cash flow on the back of that product set. If you look at our Q1 performance, a lot of people have noticed that our revenue was somewhat off compared to previous quarter. I've said this in a number of presentations in the past, that our revenue is quite lumpy in our software side of the business. At the moment, we have a number of large customers that spend multiple millions of dollars with us. Sometimes this project revenue and the delivery of the projects, the timing varies across the quarters, and so our revenue can fluctuate quite significantly. We did flag it at the end of the full year and the full year presentation that the September quarter number would be low, and sure enough it was, but we should catch up the bulk of that and possibly exceed our first half targets in the December quarter. So the software, there are three aspects of the ActivePort business. The software business we just spoke about. Global Edge is our network as a service, and so Global Edge is our incarnation of ActivePort, provided as a service to our enterprise customers around the globe. That revenue is growing quite well. We had a soft launch in Q1. We'll move across to a hard launch in Q2 and really start to ramp the revenue up on our network as a service platform in the third quarter. The managed services side of the business, we've resized the Perth branch of our managed services business for profit. If you look at our results in the full year of FY23, we were almost cash positive for the year, had it not been for some residual drag from our managed services business in Western Australia. And so we've addressed that, dealt with it, so that on a like-for-like basis in FY24 we would be profitable or cash flow positive for the year. And so the top line revenue number in managed services is off a little bit, but that's intentional, to focus on good quality revenue rather than revenue for revenue's sake. And so if we delve a little bit deeper into our Q1 performance, there are a few questions from the market about cash. One of the things that our 4C doesn't allow us to do is show our receivables number, and for the astute financial analysts amongst it, you'll see an anomaly on that chart, which is that receivables line in the software business. That is due to a number of large projects that we're seeking to close out currently, and so we hope to recover the bulk of that cash in Q2 and have this chart look like a normal chart once again. You can see with Global Edge the receivables are quite low. That's because the Global Edge business receives most payments up front from its customers, which is fantastic, and obviously we're focusing heavily on building that business as quick as we possibly can. And managed services business across revenue, cash and receivables is standard as it should be. And digging a little bit deeper into the software business, because the software business really is the cash flow driver of our company, and the business that we're really pushing to grow as fast as we can in the global telco space. You can see from this chart, which is our active sales pipeline, If I run through the columns quickly, customers on the left-hand side, second column across from the left is the one-time charge revenue. So this is money paid up front for our software and for the implementation services. MRR is monthly recurring revenue in telco speak. This is the recurring revenue from each of these customers as they go live and get into production. And that gives us an active pipeline. And by active pipeline, I mean deals that are in front of us that we should be able to close in the next few months of close to 10 million Australian dollars. And if I take this MRR number and then annualize it once these projects are all live, then you can see that that's heading up into this 7,920 number. And so that's our target recurring revenue from the active customers we have in our sales pipeline at the moment. The little footnote at the bottom says that is a 75% gross profit after we pay away some license fees to OEM software we have embedded in our ecosystem. And so this is what we would call a high margin recurring revenue base that we're looking to build out over the next couple of months. There are some large one-time payments in the one-time charge column. For some of our customers, we do what we call enterprise licenses, where they pre-purchase a batch of licenses or license capacity for a certain region or a certain telco or a certain country ahead, and then they're able to sell that product into their markets under some constraints for 3 to 5 years at a price point of their choosing. And so we do run a number of these. There are a number of these larger, what we call enterprise license deals in the pipeline, and I think we should be able to close the two at the top of the list. At least one of those in the quarter, possibly 2 in the year. And so we're quite confident that this pipeline is representative of where the company is trying to get to over the next 18 months from the software side of the business. We have a strong relationship with a sister company called Radian Arc. Radian Arc is in the business of deploying GPU servers to the telco community, primarily for cloud gaming, although some telcos recently have been using those GPUs for AI applications. ActivePort provides, first of all, the service to deploy the GPUs into the telcos and connect into their networks, but also the software that orchestrates the GPUs once they're installed. We earn a service fee for the delivery and implementation and support of the hardware and the software stack, and we earn a license fee for the use of the platform, of the software on the platform. And so as the number of concurrent users in Radian Arc's universe increases, so does our license revenue. And you can see that from the chart that the deployments are heading into production, and Radian Arc is beginning to generate that compounding recurring revenue from their cloud gaming and AI services, which will filter through into revenue, license revenue for ActivePort over time, certainly over the next 3 to 4 months. The exciting thing about Q1 is that Radian Arc closed its largest telco deal in the quarter. ActivePort was instrumental in the process of getting that done. It is large. It's large to the extent that on success of the customer signing 100 million cloud gaming subscribers, which is their objective, we would be required to deploy up to 35,000 servers across their network, which is a hardware build in the order of $1 billion. And so some respects we have a tiger by the tail with this project, but it's a fantastic project. It's one of those projects that can help us develop new tech, can help us make the platform more efficient, certainly generate significant revenue for the organization, which is a fantastic opportunity. It's early stages. The contract, as we say, was signed in Q1, but the deployment is well underway, and we hope to be able to point towards successful live production service in that particular country somewhere in Q3. A Global Edge platform. Global Edge for us is a edge to cloud service, SD-WAN edge to cloud service. We build the solution on top of our ecosystem partners that provide the network underlay that allows us to connect our SD-WAN users into a global network. As I say, we don't build the network, we provide the points of presence and the orchestration software for our customers to be able to build their own network using their own telco service providers and their own ecosystem partners like Megaport. In the quarter, we completed what I call our version 3 Megaport integration. In particular, we now have a complete Megaport Virtual Edge integration with our SD-WAN solution, which is a fantastic outcome. And over the next quarter, we will look to promote that into the market and begin to get live users on that service. It allows us to compete in the SD-WAN market against all the traditional edge-to-cloud players like Fortinet, Meraki, Velo, Versa, etc. But from our perspective, we're not providing just a product, we're providing a managed network service that allows our users to connect all the way from their branch offices right through to the cloud and connect their services around the world using our fabric provider, in particular Megaport in this case. And so a summary of Q1, soft revenue to start the quarter as current projects are completed and new projects begin. I think it's important to note that we're rolling off a couple of very large projects that we're just handing over to customers at the moment. We have another 3 to commit to paper in the current month, and then we have a strong pipeline of 12 to close out somewhere in Q3. And so while we're finishing 2 or 3 major projects, 5 or 6 new ones are starting up, which would be fantastic for our results in Q3 and Q4. We have some interesting developments in that prospect list of some subsea fiber operators. Traditionally, ActivePort has operated in the layer 2, layer 3 orchestration space, which means that we make connections across networks to cloud services and from data center to data center. But some of our customers, subsea fiber operators, where we need to go down a level to what we call layer 1 and be able to orchestrate wavelength services across subsea fiber, which is quite exciting because it opens up a whole new revenue stream for us in the telco market. And so we have 2 customers we're working with closely at the moment, in fact 3 customers we're working with closely at the moment to deploy our what we call layer 1 orchestration capability. It's an exciting development for us, somewhat esoteric if you're not a subsea fiber operator, but for the investors, the point is that this opens up a whole new revenue earning opportunity for us in our software product. And the one thing I would say is a lot of those fiber operators also use Megaport to connect their customers at high speed through to cloud service providers like AWS and Azure. And so the Megaport, our phase 3 Megaport integration is very important for our wholesale connectivity between telco and fiber operators through to those ecosystem partners into the cloud. And our software is instrumental in orchestrating those connections for the subsea fiber operator customers. Momentum building behind Global Edge, as we've mentioned, significant R&D progress on fabric integration, cloud orchestration, and network as a service. The R&D effort will also accelerate across this new opportunity for cloud orchestration, the large opportunity we spoke about earlier with Radiant Arc. That opens up a whole new avenue for us to build out a cloud orchestration suite across the GPU architecture that we deploy into the telcos, which will be quite exciting as we roll into Q4. And of course, we're seeking opportunities to expand our technical resource base for accelerated growth. We talked about this, so I spoke about this at the FY23 full year presentation. We have no shortage of opportunities for our software. We've found the acceptance of the software in the telco market has been exceptional. That has then created a challenge for us in growth. We need to expand our technical resource base as quickly as we possibly can within the bounds of our budgets to make sure that we can keep up with demand for the product, which is it's a fantastic problem to have, but it's a challenge because we need to grow the technical team that has to have some significant technical capability, and we need to grow it quickly. And we're looking at a number of options to let us do that and accelerate our growth as much as we can. That is it for the slides. Q&A. Alan, I can't see any questions from my screen, so if there are any,
let's go. Yep. Thank you, Peter. No, there is a couple of questions here from Stephen. The first one is, how many ActivePort technicians required to deploy the very big gaming solution, and how will they be sourced?
We have a core team on the GPU side that numbers around 8. The deployments, we've got the deployment process automated to the extent that we can roll out servers very, very quickly. And for the fleet of servers that we have out in the field, or Radiant Arc has out in the field now, we can update and manage, deploy content, generally administer that fleet of servers quite effectively. Everything that we do has been really well automated by the engineers. And so the challenge with deploying, it's one thing to deploy 100 or 200 servers, but deploying 30,000 servers is a different beast. We do have some really good support, or at least Radiant Arc has sought and achieved some really good support beyond the realm of ActivePort to be able to do that. And so as Radiant Arc scales its business up to that sort of size, we anticipate that we will hand over the deployment and management of the hardware to other third parties. I don't want ActivePort to become a GPU deployment shop. It's been really good to seed the business. It's been really good to get us all aligned and to get the product engineered and everything automated, but we don't anticipate doing that in the future. Our real focus for the GPU platform is to be able to build the software stack that goes on top of the servers. That's our core strength, and that's where we'll focus.
Thank you. Another question from Stephen, and I might add to this. Please elaborate on phase 3 Megaport integration, and I guess from my side, maybe elaborate, how it's come together, and I guess the rationale behind, I guess, a so-called partnership.
Yep. Always go to great lengths to explain to people that we provide a network of POPs, or connectivity points of presence, around the world that users can use to connect their branches and mine sites and factories, whatever it is, mobile workers, into their network. And so traditionally we built those points of presence ourselves. By integrating Megaport's Virtual Edge, we can enable the customers to do it themselves. And so when you look at the Global Edge product, we've almost got it to the point where we are just providing a software platform that's hosted in the cloud, and the customer can build a network from end to end without any of our infrastructure in the middle. And so a customer, for example, may have 50 branches in France and 50 branches in Dallas, and they want to connect the 100 branches together across the world. Maybe they've got a data center in France and a data center in Dallas. They can build a network that connects those 100 branches to the data centers via the Megaport Virtual Edge on a point of presence that they build themselves using our software, and connect all those people out to the cloud as well. So connect them together and to the cloud. And all ActivePort provides is the network software as a service. We don't provide any of the hardware, any of the network infrastructure itself. It's a really different take on network as a service. And the Megaport Virtual Edge allows us to do that like no other ecosystem partner does. The fact that we traditionally, with version 1 of Global Edge, we had to build the POPs in a different ecosystem partner's environment. With version 2 of Global Edge and support with the Megaport Virtual Edge, we can now allow the customer to build the network from end to end on the Megaport ecosystem without any intervention from us, which is a fantastic step up in the evolution of the product. And so Megaport Virtual Edge integration is, if you look at the way Megaport's Virtual Edge providers, whether it's Meraki or Fortinet or any of those other SD-WAN providers do it at the moment, It's a two-step process where you have to buy the product from, say, Fortinet, then you have to buy Megaport Virtual Edge, and then you have to use the two different systems to be able to bond together a service to get out to the cloud. In the Global Edge case, it's a one-step process. You go to the Global Edge screen, register, log in, and you can build that network end-to-end, all the way from your branch across the world using Megaport and into a cloud service provider like AWS from a single screen. It's quicker, it's easier, it's more cost-effective, and you have a lot more features available to you as a network builder to create a SD-WAN network using Global Edge and Megaport's Virtual Edge than most other providers in the marketplace.
Got it. And from a revenue perspective, can you elaborate what that means to you from an ActivePort side?
Well, the great thing about the revenue from a network as a service platform is the quality of it. I think in the cash graph that we had earlier, you can see that there just are very limited receivables outstanding in the network as a service business, because typically people pay for those things up front. So I think, first of all, the quality of the revenue is great for us because it generates cash flow in advance and prepaid. The other side of it is that the SD-WAN market itself is, last time I looked, was a $60 or $70 billion global market. And so there's a lot of revenue earning potential there, but it's a fairly crowded space. And so what you have to have to be successful is a product that differentiates you against all the other brand name competitors in the SD-WAN market. And I think with Global Edge, we do have that. As a regular R&D exercise, our tech teams trial our competitive products. And certainly we believe that using Global Edge to build an SD-WAN network is a lot more effective, more productive, cost-effective, better experience for the end users than you would get from attempting the same outcome with some of those brand name products. And so we think that out of that $60 to $100 billion SD-WAN market, we have an opportunity to gain a large portion of the market. And also with our relationships with telcos, we use the Global Edge infrastructure as a shared service for our telco customers as well. And so we get two bites at this. We get to sell the Global Edge platform as a retail solution for SD-WAN, but we also use the same ecosystem for our telco partners to connect in through to the world as well. So we call it network augmentation with our telcos, where a telco may have 10 regional points of presence around the world. They can now make that 2,000 regional points of presence just by using our Global Edge infrastructure and ecosystem partners like Megaport to be able to stand up their own points of presence in other regions around the world where they otherwise don't have capacity.
Very good, thank you. Question from Richard. Can you confirm why in the software sales pipeline, MRR doesn't include your other 15 clients? Why not base it on your 27 you have?
Yeah, that list is just an abbreviated list of the ones that we're trying to close right now. In fact, one of the largest ones on that list, we're literally waiting for a signature. Maybe when I get off this call, we'll have it in my inbox. So they are just the current opportunities. And when I say that we're spoiled for choice when it comes to projects, we're not starved of opportunities. That is the challenge. We have our software deployed in 27 locations around the world, and we're actively trying to close orchestration projects with 12 of those that we should be able to do in the next, certainly the bulk of them this quarter and a lot early in Q3. But whoever asked the question is correct. We've then got 60 other telcos in behind those that we need to actively engage with to see what sort of outcome we can get. So yeah, we've got a huge pipeline of opportunities. And I think I've said this before, for what we do in the telco sector, it's not like an SD-WAN, there's 30 or 40 competitors. In what we do with our software in the telco sector, there's one or two. And so what we find is that when we engage with a telco, we typically get a positive outcome in terms of a deal and some licensing revenue on a project. And so our challenge isn't finding opportunities. Our challenge is having the resources to engage with the telcos and deliver a good result.
So these 15, they're close to, I guess, revenue conversion. Yeah.
And they're close to signing a contract with us to do the implementation. We're really mindful of the fact that we don't want to sign too many too quickly and not be able to deliver a good outcome, because that can be as bad as not having any opportunities at all. And so we're trying to stage the conversion of the telcos to live projects to match our resource capacity. And so we're living within constraints of our cash and constraints of our resources right now, not constraints of the market at all.
Good. Thank you. Another question from Cyprus. Given demand outstrips supply, as in deployment capacity, are you able to increase your prices?
We are able to modify the price. And we're also able to do some interesting things like provide these enterprise licenses that help us fund our growth. And so, yes, we get increased prices to the point that we only have 3 customers, but I don't know that that would be the right strategy. We do look closely at the pricing. Typically with the telcos, we begin with a simple an implementation as we possibly can to make sure that the product is accepted and functioning, and the telco themselves are able to then take it and expand its use across their network. And so I think in the telco sector, it typically, even if you start at a very high price, if you're successful, it ends up a volume play more than a margin play. And we're quite happy with that, because the telco sector is huge. And so we don't want to price ourselves out of the market. But we also, it's a very good point that Cyprus brings up, we also look very closely at each engagement and make sure that we're pricing it to a way that as we bring on more resources, that we make a profit from having those people on payroll. So for example, there's always a temptation to underprice the deployment service to make sure it's easy for the customer to digest the cost. But of course, with telco, once we're engaged for a long time. And so we've got to make sure that the revenue we're generating from the software is covering at least the fixed cost of having a team that is somewhat permanently engaged with that telco on building new features and handling rollout and so on. And so, yes, we can certainly price our service to a point where we're making a profit without pricing it to the extent that we start to lose business.
Thank you.
Peter, it's Alex Sundich from Bridge Street Capital. Just one from me. As a veteran of the telco industry, as you are, global telco industry, do you have any comments about the Optus network outage yesterday? Does that have any implications for the providers of network as a service? Are we going to see more people wanting to avoid the latency of these huge legacy networks to create their own networks? And does that have any implications for ActivePort?
I think it does. I think there'll be a certain amount of churn across to some of the services we provide, because people will be a little bit cautious, so there'll be that knee-jerk reaction. I think an outage like Optus's, and I think the last outage that I ever read about that was similar scale was in Canada in 2022. There was a telco there that had a similar full-day outage for a similar reason as well. I think what it does is it focuses people on redundancy. And our networks as a service platform is all about redundancy and providing people with cost-effective, high availability global networks. And so, yeah, I think it will help people refocus on a need to not just rely on a tier 1 telco to always be there for them. And it doesn't happen very often, and feel really sad for the people at Optus that had to deal with it. It must have been chaos yesterday and probably still is today. But from our perspective, it does refocus our customers on the need to have dual redundant links and packet level failover and all the features that you get with our Global Edge product and our SD-WAN solution.
And final one from me, you mentioned there's going to be a hard launch of the Global Edge product this quarter, the quarter we're currently in. What's that going to involve, and can you see this product actually going a bit viral and really taking off? What's it going to take for it to really start revenue to really start ramping?
I think the revenue will ramp just by word of mouth and through the marketing effort that we put into it. I think the product, once you use it, it will sell itself because it's such a compelling alternative to the other SD-WAN solutions that are out in the marketplace. But it's a bit of a double-edged sword in that I personally have been holding back the hard launch of the solution until it's absolutely bulletproof and world-class. The challenge I think we're going to find with Global Edge, and certainly with the connectivity through to our ecosystem partners, and in particular Megaport, because Megaport product globally, it doesn't matter what telco we deal with, everybody knows the brand and everybody uses it somewhere in their network. And so I think once you go to market with a retail solution that has that, both the profile that we will get from our ecosystem partners, but also the demand that we're likely to generate through the telco industry and our telco customers, the product has to be rock solid. We can't launch it and with an expectation that we'll get 1,000 users in Australia in a month. We have to launch it with the expectation that we might get 10,000 users globally in a month. And I don't want to be in a situation where we turn it on and then we have to scramble really hard to keep up. I want to make sure that when we launch it, everybody has an excellent experience and everybody realizes it's a fantastic product, because I think that word of mouth will be the most valuable marketing that we get. We get one shot at it, and we need to make sure that we do it really, really well. And so we have a team of people in the Global Edge side of the business that some of them we've seconded from our managed services business, that are working really hard right now to just stress test and really dig into the workflows and make sure that everything works well and everything is as optimized as it possibly can be and is as easy to use as possible and self-explanatory for new users that try it for the first time.
Thank you.
Another question from me, but just to back to the pipeline, and obviously your software sales are being a bit lumpy. Is there a sense that closing the pipeline in the next quarter sort of irons out that lumpiness, and then we can sort of move to a non-lumpiness and recurring is a bit more sustainable? Is that something how we should think about that? And
forever known, Alan, as the non-lumpiness sales strategy. The interesting thing about a 4C, which I always cringe when I read 4Cs, is the 4C. I guess the point of that chart in this deck is to help explain where the business is at. We don't have a lumpy sales experience. Our sales close rate and our sales growth is actually accelerating quite smoothly. The challenge is lumpiness of cash receipts. And the challenge with the 4C is that there's a box for cash in and there's a box for cash out. There's no box for creditors and debtors. And so it doesn't really paint, I'm sure when it was invented by the ASX, it painted a great picture for mining startups that don't have any revenue. But it doesn't really paint a very good picture for fast-moving software providers like us. And so we don't have lumpy sales. The sales are quite consistent. What we've got is what we're doing though is selling projects with large revenue attached to them in large lumps. And so if we have, for example, one of our projects in Africa should have closed last quarter, but didn't. And when I say close, we've been delivering it for a year and a half now. So we're at the final stage of handover to the client. It drifted to the right by 6 weeks. And so bingo, there's like $800,000 of cash receipts that didn't hit the 4C. If it had, then the 4C would look like last quarter's 4C. So that's just one example of many in our delivery pipeline where It's not a sales issue. Where the sales are going fine. It's just the cash receipts come in large chunks. And if something drifts to the right across a quarter boundary, it looks like we had a cash issue in the quarter, which technically we did, but not to the extent that it doesn't exist, just that it's moved to the right.
Understand. So basically, we'll be back on track on that growth trajectory post next quarter, I guess is the way.
Yeah, and it's like if you look at it over the last 6 quarters, it could be really high one quarter and really low the next quarter. And it's just going to be a repeat of that pattern until we get enough of these telcos live that the underlying recurring revenue starts to outstrip the project revenue. And once we get to that point, then the recurring revenue growth will be obvious, and the project revenue won't impact the cash receipts in a quarter as much as they currently do. And also, once we get to the point where we're fully self-funded, we probably won't pursue the enterprise licenses that we're doing at the moment to provide us with that working capital. Should we hit that we need, we'll move just to a pure recurring revenue model for all the telcos that we engage with. And so then, as I say, we should see a small portion of the cash receipts and the revenue every quarter as project and implementation revenue, and then that recurring revenue should start to ramp up, and it'll become obvious what the growth trajectory of the software licensing revenue of the business is.
Perfect. I guess one more from me. Obviously, Megaboard, huge achievement. Historically, we've spoken about Telstra and Focus. Any further developments there or conversations on what that might look like going forward for you guys? Yeah,
we're strangely enough, we didn't mention Optus. We deal with a lot of telcos in different parts of the world. We are still talking on a regular basis to most of the Australian telcos, certainly the ones you mentioned. Nothing in particular that we could talk about to the market. But similarly around the world, we've deployed our software to a number of Orange subsidiaries, the Orange telco, in interesting places like Morocco. We have deployed to almost all of the telcos in India, and we're looking to complete some projects in that part of the world. A lot of telcos through Southeast Asia, a number of telcos in North America, some really great telcos in South America. And so the telcos we're engaged with, that we're engaged with is a global thing. But certainly the Australian telcos are in that mix, and we'd be really excited if we could get one or two of those over the line the next couple of months.
Yeah, got it. Perfect. Thank you.
Any other questions?
Okay, anyone? Yeah, that's from the panel. Yeah, any other questions? If not, we'll call it then. Peter, thank you again for the time today. And if there's any further questions, feel free to come out to myself or Alex. And if we can't answer ourselves, we'll get Peter involved. Again, thank you, Pete. Thank you, everyone.
Thanks, Peter.
Brilliant. Thanks, Alan. Thanks, Alex.